This quarter, you're seeing a company deliver a stunning 272% year-over-year growth, the kind that completely blows up analyst models, while raising next quarter's revenue guidance to nearly $100 million above market expectations. This isn't a normal earnings report. It's the moment the AI infrastructure demand curve fully ignited. Hey everyone, this is Deep Dive Stock Earnings. After going through Credo's Q2 report, my feeling is pretty direct. This company isn't growing, it's sleeping. EPS smashed expectations. Revenue exploded. Margins were unbelievably strong. Cash piled up to more than $800 million. And the stock's price action before and after earnings showed a major structural shift, clear signs that institutions positioned early. I'll have Katarina break down the numbers first, and then we'll look at the stock trend to see what the market actually thinks.
The most direct highlight this quarter is the numbers themselves. The market expected EPS of 49 cents, but Credo delivered 67 cents. Revenue was expected to be $235 million, but they delivered $268 million, beating by more than $30 million. And the truly shocking part is the 272% year-over-year growth. You almost never see numbers like this from a mature tech company. Even quarter over quarter, they still grew 20%, which means demand isn't a fluke, it's deeply sustained. The CEO directly said this is the strongest quarter in the company's history, and they kept non-GAAP gross margin at 67.7%, meaning this explosion wasn't driven by cutting prices, but by true product-driven scale. By the end of the quarter, they held $813.06 million in cash and short-term investments, which is exactly the kind of balance sheet that lets a company accelerate expansion anytime it wants.
So what you're seeing here is a full spectrum. No weakness quarter. Revenue, EPS, margin, cash, everything points in the same direction. Accelerating demand with a very healthy structure.
Why is the growth so aggressive? The core reason is AI infrastructure. The CEO emphasized in the report the growth comes from massive build-outs of the world's largest AI training and inference clusters. The hyperscaler arms race is accelerating, and Credo happens to sit at the most critical point of the whole system, high-speed interconnect. They don't make PUS, but GPU performance and scale depend entirely on high-speed Ethernet. 100Gs, 400Gs, 800Gs are already standard, and the next stage is 160 to maintain stability, low power, and long-distance performance at these speeds. You must rely on their SerDes and DSP technology. Then it flows into two core products, X high-speed chips and X active electrical cables. X embed Credo's chips directly inside the cable, allowing data to travel farther and faster with lower power. In dense AI data centers, this has basically become a must-have component, and this isn't just one product line. They have an entire pipeline line of ZeroFlap optics, AECs, OmniConnect gearbox, all aimed at 160 era. So the explosion isn't an accident, it's a multi-product roadmap hitting maturity at the same time.
This isn't a company that sells cables. This is the nervous system of AI data centers. The stronger AI gets, the more essential they become.
Now let's talk about the stock, because the price action aligns perfectly with the fundamentals. Before earnings, the stock had already been rising for several days, with volume clearly increasing, a classic sign of institutions placing early bets. Once the earnings dropped, the stock immediately jumped nearly 12% after hours and broke out of a long consolidation range. Even more important is the trend structure itself. For months, CRDO looked choppy, but every pullback was quickly bought, showing accumulation at the bottom. After earnings, the entire trend shifted into acceleration mode. A breakout from consolidation into acceleration usually means long-term capital now recognizes the company is entering a new growth phase. As long as price stays above the breakout zone, the trend continues, and the fuel pushing it higher is the AI infrastructure demand that will be recognized in revenue over the next several quarters. In other words, this isn't a news pop. The stock is starting to reflect future real growth.
The chart is telling you the same story the earnings told you. Accelerating growth, trend reversal, and early institutional accumulation. And a trend never starts from nothing. The force behind it is always the future a company is signaling.
What truly ignited the stock was next quarter's guidance. Credo gave revenue guidance of $335 million to $345 million for Q3, while the market was only expecting $247.06 million. This isn't a minor raise, this is rewriting expectations entirely. Even better, they expect non-GAAP gross margin to stay at 64%-66%, which means they're not buying growth with discounts, they're scaling with high-efficiency products. The CEO also made it clear that this strong growth will extend into FY 2026 and beyond. The key isn't will growth drop, but where will growth settle, and right now, it's clear the company has stepped into a new long-term growth platform.
If I had to sum this quarter in one sentence, Credo's Q2 wasn't about reporting a strong quarter. It was about lifting the entire growth curve to a new level. AI infrastructure demand is exploding, and they sit exactly where the bottleneck was forming. Strong earnings, strong guidance, strong cash, strong trend. This is a company entering high-speed mode. This is Deep Dive Stock Earnings. I'll see you in the next one.